Hi, today we are going to go through basics of trading. Now let me go through what is called trading basics first and what is called trading. Now trading is the activity where one commodity is exchanged for another. Therefore trading is always trading in pairs. For example, trading can be done with USD JPY, which stands for the US dollar as well as Japanese yen pair, or EUR US dollar, which is the euro dollar pair, or the XAU, which is gold versus the US dollar pair, or oil versus US dollar pair. Trading is always done in pairs. Next, let me share with you why you should be investing in the largest financial market in the world, which is currency. Because all are individual accounts and it's very transparent. Today, you can open any forex trading account with any broker in the world. Next, it is a 24-hour by 5 market, meaning to say it trades 24 hours a day and 5 days a week. And because of the trading volume of $4 trillion on average, it is a very big market where it is called a non-manipulative market. The next is because of the high liquidity, there are lots of trading opportunities. Well, to compare the foreign exchange market to the stock market, it is like whatever that you see in the stock market in a year is probably what you can see in the foreign exchange market in a month. And because of such a high volatility, you have lots of trading opportunities. The next, there is literally no bull or bear market in the currency market, because you can buy first, you sell later, or you can sell first, and buy later. Either way, you can still profit from the market. The next is the ease of funds flow. Because it is a cash account, you can actually withdraw your account at any point in time. Now, what is the beauty of Forex online trading? Now, Forex is basically trading on money, and therefore if today you have some money on hand, you can actually put it onto the internet and you can trade and make the money and then convert back your money into your base currency and to be spent in your local market. Now, who are the players in the market? One of the major players are the central banks. The central banks controls the interest rate for the whole country. So when central banks intervene by controlling the interest rate, it actually will cause the fluctuation in the currencies. The next are the commercial banks as well as the financial institutions. The commercial banks act on behalf of the big players in the market and also to help them to transact from one country to another country in terms of the currencies. The next are big importers and exporters. Importers and exporters like Nissan, like Toyota, or any of the big importers and exporters. The next are the hedge funds. The hedge funds are probably one of the very big speculators in the market, where they go in positions, they take positions with the market to actually move the market quite a fair bit. The next are the business travelers and the tourists, which are people like you and me. When we travel overseas, we need to convert the currencies to the local currency in order to use the money. And the last are what we call the retail traders. There's a vast number of increase of the retail traders since the 1990s, especially the mid-1990s, after the internet became accessible to a lot more people. Now, it is estimated around 40 million people in the world who are retail traders. Now, for FX Basics, we're talking about currency pairs are all different because they're all traded in different pairs. Okay, and all the major pairs that we're trading in the market, for example, it could be USD, which is United States dollar, or Euro, which is EUR, or UK, which is Great Britain pound, or Japanese yen, or the Swiss franc, which is the Switzerland dollar, as well as the Canadian dollar and the Australian dollar. And these 7 currencies are what we call the G7s, which are the major currencies in the world. The rest of the currencies are what we call the minors. Coming back to what I call the currency pair, we have 2 currencies that you see. The one on the left and the one on the right. The one on the left is what we call the base currency, and the one on the right is what we call the quote or the counter currency. So for example, in the USD JPY pair, the US dollar is called the base currency and the quote currency is the yen, Japanese yen. Or in XAU US dollar, which is gold. So gold is the base currency or the base commodity with US dollar as the quote currency. And if, for example, in oil versus US dollar. Oil is the base currency and US dollar is the quote currency. Now the base currency or the base commodity is always on the basis of one unit. Meaning to say, if USD JPY is quoted on 93.18, therefore 1 US dollar is buying 93.18 Japanese yen. Or in the case of oil versus US dollar, it is quoted at 81.72. Now 1 barrel of oil would cost 81.72 US dollar. Coming to the charts. Now how do we look at the charts? Now if we see the chart's price movement is going up, now it says that the base currency is strengthening, or it also means that the quote currency is actually weakening. Now if we see the market is trending very fast upwards, that means it's a fast uptrend market, it says that the base currency is strengthening fast and the quote currency is actually weakening fast, and therefore you have an uptrend fast moving market. And for example, an oil versus US dollar, in this case you see a downward trend. You can see the base currency or the base commodity is actually weakening, or the quote currency, which in this case is strengthening. With the base currency that is weakening fast and the quote which is going up fast, therefore we have a fast downtrending market. Next, we have USD JPY. If you have USD JPY which is strengthening and you have JPY which is weakening, then overall we will see an uptrend market. Next, we talk about the 60-30-10 rule. Now in the 60-30-10 rule, we say that 60% of the time the market is in the range, and 30% of the time the market is in the trend, and 10% of the time the market attempts for a breakout. Now why is it important to know this? Because we need to know what market are you trading. Is the market in the trend or the market is a range? Because we all must understand that if the market is a trend, we need to use a trending strategy. Or if the market is a range, we need to use a ranging strategy. Now, with only a right market that you'll be able to identify together with a right strategy, and therefore you will have a winning game. And this will then help you to profit from the foreign exchange market. Now there are three pillars to profitable trading. And the first pillar is what we call the methodology, or what is commonly known as the trading strategy. Now in methodology, we talk about it's only about 5% of the success in your trading. The next is what we call the psychology, which is differentiated into market psychology as well as individual psychology. Psychology is 80% of its success in trading. Now what we meant by market psychology is to able to identify which segment of the market is in, whether the market is in trend or when the market is in range. Individual psychology meaning to say how you manage your emotions when it comes to the stress, when it comes to your greed factor or your fear factor. These are all individual psychology. The last is what we call the money management. And the money management is a set of rules that you set in order for you to trade, which is 15% of the success in trading. Now I'm going to cover the foundation of profitable trading. The foundation of profitable trading, it requires you to understand there are three components of the trade. Now this comes in sequence and you do not jump the sequence. The first is to identify the market direction. Meaning to say you must identify whether the market is a trend or whether the market is a range. Even when the market is a trend, you need to understand whether the market is going up, which is called an uptrend, or whether the market is coming down, which is a downtrend. The next, then we identify the entry point, which you only identify after you identify the market direction. Now as entry point, we want to look for what price are we looking at to enter the market. The last is what we call exit points. Now there are two exit points. The first is what we call the stop loss, which stands for SL. It's just in case if the market goes against us in the direction that we anticipate, or if the market goes in the direction that we anticipated, it will hit our TP, which is called target profit. Well, the market is either in a range what happens after a range is the market will go into a trend. And what happens after the trend? The market goes into another range. And what happens after the range again? The market goes into another trend. Well, in this case, because the previous trend is uptrend, the current trend is downtrend, this is what we call a reversal. Now, there are only two kinds of trade that you can put in Forex. It's either a sell position or a buy position. Now, for a sell position, which is also known as a short position, now just remember S and S, short for sell. Now, when do we want to put a sell position? It's when we anticipate the market is coming down. Therefore, we anticipate the market is coming down. The entry point, let's say, is at this point. Coming down is where our target profit is because we want the market to come down. Now, just in case the market is going up against our anticipation, we need to put our stop loss, which is higher than the entry point. Now, we can also do a buy position, which is also known as long position. Now, for long position, we have the entry point in the center. We anticipate the market is going up. Therefore, the target profit will be higher than entry position. And just in case if the market will go against us, we hit our stop loss, which is lower than the entry point. Now, I've covered the basics of trading. I want to wish you happy trading and wish you success in trading. Thank you.